and statutory tariffs and then consider their estimated effect on the global stock market for the week ending July 18, 2025. Effective tariffs versus statutory tariffs. Statutory tariffs, or applied tariffs. These are the official, published tariff rates that a country applies to imported goods. They are the rates written into law or trade agreements. For example, if a country states it has a 10% tariff on imported cars, that's the statutory tariff. Effective tariffs. This term refers to the actual amount of tariff revenue collected as a percentage of the total value of imports, or the real impact of tariffs on prices after considering various factors. It can differ from statutory tariffs due to exemptions and waivers. Specific goods or countries might be exempt from certain tariffs, or companies might receive waivers. Trade deals. New trade agreements can lower or eliminate statutory tariffs, changing the effective rate. Trade diversion. Importers might shift sourcing to countries not subject to tariffs, or reroute goods through third countries, thereby reducing the effective tariff paid on goods that might otherwise be subject to higher statutory rates. Substitution effects. Consumers or businesses might switch to domestically produced goods or imports from other countries, leading to a reduction in the volume of goods subject to the tariff. Pass-through rates. While tariffs are paid by the importer, the actual economic burden can be shared between the importer, exporter, and ultimately the consumer, depending on how much of the tariff cost is passed through to prices. In essence, statutory tariffs are the stated policy, while effective tariffs reflect the real-world impact and collection of those duties, which can be lower than the statutory rate due to market responses and policy adjustments. Estimated effect on global stock market, week ending July 18, 2025. Based on the information available, the week ending July 18, 2025, has been characterized by continued uncertainty and modest volatility in global stock markets due to ongoing tariff concerns. Here is an estimated breakdown of the effects. U.S. markets, S&P 500, Dow Jones, NASDAQ. The week likely saw a mixed to slightly negative reaction in U.S. markets. Reports indicate that U.S. stock markets edged lower earlier in the week, around July 14th, after President Trump announced new tariffs on goods from the European Union and Mexico, raising concerns about renewed trade tensions. Despite this, major indexes remained near record highs, suggesting that while tariffs cause some jitters, investors are also holding out hope for negotiated outcomes and may be desensitized to some degree by repeated tariff threats. Tech stocks, in particular, seem to hold up better in some instances. European markets, Germany's DAX, France's CAC 40, European markets likely experienced declines. Given the new tariffs announced on EU goods, indexes like the DAX and CAC 40 were reported to have fallen, as these economies are expected to face significant economic fallout if the tariffs take full effect. Asian markets, China's Shanghai Composite, Hong Kong's Hang Seng, South Korea's Kospi, Japan's Nikkei 225. Asian markets showed a mixed picture. While some, like Japan's Nikkei and Hong Kong's Hang Seng, saw slight gains or were mixed, others like South Korea's Kospi might have slipped. Chinese shares generally advanced, boosted by stronger than expected export data and a truce in the U.S.-China trade spat, indicating some resilience or a temporary reprieve from direct tariff escalation. The ongoing speculation that tariffs might ultimately be softened or involve further negotiations likely prevented a widespread panic. Overall impact summary. Uncertainty and volatility. The overarching theme is one of uncertainty. The persistent threat of new or escalating tariffs, coupled with ongoing negotiations and shifting deadlines, like the August 1st deadline for some tariffs, keeps investors on edge. This uncertainty can lead to significant intra-week and intraday fluctuations. Sectoral differences. Industries heavily reliant on global supply chains or international trade, for example, manufacturing, automotive, agriculture, are more vulnerable to tariff impacts and may see greater negative effects. Conversely, sectors with less international exposure or those benefiting from domestic demand might be more resilient. Potential for negotiation. The fact that tariff implementations often come with deadlines and room for negotiation means markets don't always fully price in the worst-case scenario. There's an underlying hope that trade deals will be reached or tariffs will be scaled back. Broader economic context. While tariffs are a significant factor, other economic data, for example, inflation readings, earnings reports, and geopolitical events also play a role in market movements. In conclusion, for the week ending July 18, 2025, the global stock market likely saw a modest negative to mixed reaction, driven by renewed tariff concerns, particularly affecting European markets, while Asian markets showed varied responses and the U.S. market experienced slight dips but largely held near record highs, reflecting a wait-and-see approach amid ongoing negotiation prospects.
I don't think so. No, 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 no.